All right, welcome to the Explainer. So, have you ever wondered why some countries, say like Germany, just seem to always run these massive trade surpluses, while other countries are kind of stuck in deficits? Well, the answer is probably not what you're thinking. It has less to do with currencies than you'd imagine, and a whole lot more to do with a hidden engine that's really driving the global economy.
So let me ask you this. When we talk about a country's trade balance, what are the first two things that pop into your head? Go on, think about it for a second. If you're someone who follows the financial news, you're probably thinking about, the value of a country's currency, right? Or maybe the economic health of its trading partners. And look, you're not wrong. Those are the usual suspects. And yeah, for decades, economic theory has basically told us the same thing, that exports move based on exchange rates and how well a partner country's economy is doing. A cheaper currency makes your stuff more attractive, a richer partner buys more of it. Seems simple enough. But what if there's something deeper going on? A more fundamental driver? Well, there's a growing body of research that shows that what a country trades, we call it its trade composition, is actually a way more powerful predictor of its economic fate.
Okay, so let's really get into this. We're going to look past all the noise, the day-to-day currency swings, and really explore what this idea of trade composition means for a nation's economy.
So, what are we talking about here? It's really not about the volume of trade, it's about the type of stuff a country is buying and selling. Think of it like an investment portfolio. Is your portfolio packed with volatile commodities like oil, where the price is all over the place? Or is it diversified with, say, high-growth technology stocks? That exact distinction, whether your export basket is full of raw materials or sophisticated, high-value manufactured goods, that, as we're about to see, makes all the difference in the world.
All right, to really see this in action, our first stop is Russia. Russia is a perfect case study because its entire trade story has been shaped by a massive concentration in just a couple of key exports.
Just look at this number, 47%. At its peak, nearly half of everything Russia sold to the rest of the world was crude oil and natural gas. I mean, that's not just a statistic, it's a fact that completely rewires Russia's entire economic relationship with the world. And it's all because of one very unique property that these goods have.
And that property is what economists call inelastic demand. Look, in simple terms, the world needs energy. It's not really optional. Whether the price of oil is sky high or in the basement, industrial economies have to buy it to keep the lights on and the factories running. What that means is that Russia's customers can't just easily cut back. This gives Russia's main exports an incredibly powerful and stable source of demand.
And this right here, this is the result. It illustrates it perfectly. For more than 2 decades, Russia has run a massive, persistent trade surplus, averaging almost 9% of its entire GDP. Now, this isn't happening because of some clever currency manipulation or a weak ruble. Nope. It's a direct consequence of exporting stuff the world absolutely has to buy, pretty much no matter the price.
Okay, so let's shift gears and head over to Europe. This is a totally different context, but it builds on the same idea. See, inside the Eurozone, all these countries share the same currency, the euro. So exchange rates just can't be the reason why some nations, like Germany, consistently rack up huge surpluses, while others, think Greece or Spain, are facing these persistent deficits. Something else has to be going on.
This slide, man, it just cuts right to the heart of it. The real dividing line between the Eurozone's trade winners and losers isn't debt or government spending like you hear about in the news. It's industrial specialization. It's what they make. Countries like Germany and the Netherlands have literally built their economies around exporting high-value, high-technology manufactured goods. Meanwhile, the deficit nations, well, they just have a much, much lower share of these kinds of goods in their export mix.
And listen, this isn't just some theory, the data is crystal clear on this. Research looking at the first 12 Eurozone countries, the EA12, came to a pretty stark conclusion. They found that the traditional factors, relative prices and income, were, and I'm quoting here, basically irrelevant for explaining their trade balances. The only factor that consistently and robustly explained who is winning a trade was their export composition. That's it!
Now for our final case, let's turn to developing countries, because this is where the relationship between trade and growth takes a really fascinating and, honestly, a completely counterintuitive twist.
For decades, the mantra for developing economies has always been export-led growth. The idea was simple. Just sell more stuff to the world and your economy will grow. But when researchers did a deep dive into the data for 19 developing countries, they found a pretty surprising truth. The sheer volume of exports, and even the type of goods being exported, often had a, pretty insignificant relationship with actual economic growth.
So, okay, if just exporting more isn't the silver bullet, then what is? Well, the research points to two other really critical factors. First, growth is strongly linked to importing high-tech and capital goods. It turns out that bringing in advanced machinery and technology is what actually kicks domestic productivity into high gear. And second, it's about increasing the domestic content of your exports. You've got to make sure that the goods you sell are built with locally produced parts and labor. That's what creates a virtuous cycle right there in your own economy.
So, we've looked at a commodity giant, a high-tech trade bloc, and a group of developing nations. What's the big takeaway here? What's the crucial point that ties all of this together?
When you kind of zoom out and look at the big picture, a really powerful unifying principle starts to emerge. For Russia, what mattered was the price inelasticity of oil, the fact that people had to buy it. For the Eurozone, it was the high value add of their technology exports. And for the developing world, it was the productive power of imported machines and the economic linkages of using domestic parts. See the pattern? In every single case, the physical and economic characteristics of the goods themselves are what truly shape the outcomes. It's so much more important than just exchange rates or simple volumes.
And that leaves us with a pretty provocative final thought. If the structure of a country's trade, what it's selling, is the main engine of its success, then it kind of forces us to question whether a purely hands-off approach to trade is really the best strategy. Should governments be actively trying to shape their country's industrial and export profile? I mean, that's a question that really challenges decades of economic thinking, and it's one that's probably going to define the future of global trade.